We've reached a critical inflection point where thinking about financial market cycles is a gripping trader and investor topic. But it's not all cut and dried. At least that's the latest thinking from our chief equity strategist and economist, John Blank, who's here with me now to dive into this further. So, John, how does this all relate, these cycles, to the U.S. stock market?
Yeah, let's just talk, Terry, about the Shiller PE ratio. We gets thrown out there as a 10-year backward-looking price-earnings ratio on stocks. I got it at 32.65 here in the middle of 2022. That's actually back, within range where it was at 2018 and 19. However, back in 2012, it was down at 21. And back in 2000, it was actually up at 44. So you say, well, John, we're at 32. We're not at 44. That's true. We're not at the 2000 level. We're not at 20 either, Terry. So the point is, we're in a situation post-COVID, which we haven't been in before. We're seeing low growth at high levels of unemployment or employment with low unemployment. So we got a full capacity economy running at slow growth, and profits are pretty good. And the stock market's kind of midway between the 40 of 2000, it's 32, and it's midway between the 20 of 2011 and 12 when we were really depressed. You say, is that right or wrong? Probably the market's doing the job it needs to do right now, but we got to pay attention to it.
What about the bond market? How are these cycles applying to the bond market?
Yeah, well, so the equity risk premium on the stocks I'm looking at is 4.56. So that's the amount of cash you get up holding a stock if you actually own it like a bond. Right now, the 10-year this morning is about 2.7, 2.67. So you can see right now, because the 10-year's fallen apart a little bit, we got 2% more return to stocks than bonds. So in light of people's understanding now that the 10-year really may not get much higher than 3%, stocks can get a bid. That's why the stocks aren't being sold off much today at July the 28th after we got the weak GDP report, because the bond stock trade-off in the financial market context, when you look at equity risk premium versus treasury rates, is you actually got a little more favorable today.
And taking this a step further, maybe, does this situation with cycles also impact that inverse relationship we've always seen between the stock and bond markets?
Well, Terry, I think we'll find out. I mean, again, I think everybody needs to understand in the environment we're in, the Federal Reserve System is in the center of this, and they are trying their best to understand a very uncertain landscape. In every meeting they have, they're showing up like they always do, and they say data dependence, but the data can really change their mindset. And this is the new reality. So framework wise, yes, it's true that lower bond rates will get higher stocks, but we've played that game out now for 7 months, and we'll see what happens going forward. And I would not keep my thinking around that everything has happened in the last 6 months will keep happening. I think that's probably not the right way to look at it.
And will financial market cycles be something that investors absolutely need to focus on going forward?
Yeah, I just think we need to step back. It gives a nice way to step back, Terry, and look back and realize every cycle you're in has some dynamics that are unique to it, and to have a little more agnostic view about trying to interpret it and just get more comfortable with being vigilant and paying attention to what people are talking about, in particularly with the Fed and what they come up with, and realizing that this is, as they say in the Chinese language, crossing the river by stepping on the stones, meaning you do one stone at a time for the next year or two.
Yeah. Well, one thing investors have been focused on lately is the Q2 earnings season. Is that adding to current investor pessimism in the market?
Not really, Terry. It's a mixed report. Obviously, there's been plenty of people pulling back on their outlooks because people are apprehensive about things. But in general, we've seen, for the most part, that the consensus has been largely met in the Q2.
And what do you think corporate America is saying about our economy through their earnings reports?
I think they're saying, we're nervous, but we're doing fine, and we're doing better than you think, because the worrying has gotten excessive and one-sided, because it's really about what the Fed is going to do, not what the economy is doing. So people get ahead of what the economy is doing. The economy is fine. The labor market's strong. Growth, the overall level of growth and activity in any situation right now is very high, actually. And so the growth rates at a high level of activity aren't as demonstrably worrisome as people think. But the fact the Fed is cranking rates up so quickly spooks a lot of people into a forward panic. And then they think, there's going to be a recession in the fourth quarter of 2022 or first quarter of 2023. Every single economist call I get on, a strategist call I am, everybody's out there 6, 8, 10 months from now looking at a recession, and they're all placing their decision-making now on something they think is going to happen a year from now.
So what do you make of the big tech earnings that just came out?
There we saw the ad slowdowns, Terry, particularly on Facebook and Google. And this is in Snap. And these things are to be expected. People are going to take the discretionary things down first, and that's advertising.
Okay, speaking of tech earnings, let's look at three major tech firms now that you've been looking at: Broadcom, Prosus, and NetEase.
Yeah, Broadcom used to be a $600 stock. I had it at $530 now. I got a Zacks number 4 rank. But a B for growth. Broadcom's a classic, super strong chip stock. PEG ratio of 1. I'd be tempted to be a buyer of this because of the chip package with the Senate. Prosus, you probably don't know this name. It's actually in the Netherlands, e-commerce internet site based in the Netherlands. So again, you're talking about a stock that's only $13 because all the depressed views of things with stocks in Europe. PEG ratio 1.4. I actually, again, probably take a look at Prosus because I think it's probably a strong stock. NetEase, this is another darling U.S. tech stock, development of apps, services, and other technology for the internet in China. This company, PEG ratio 1.4, $95 a share. You got to like this type of stock. Again, if you're looking to pick up things that are, as a bargain shop or bottom feeder now that everybody's decided there's no growth. And in fact, we might be surprised that these are the names that actually get a bounce out of them because they're cheap now.
Our chief equity strategist and economist, John Blank, on financial market cycles and Q2 2022 earnings. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.